All right, in today's video, we are going to look at a specific case study of an individual who's funding a whole life insurance policy with a lump sum of $1 million. What we're going to look at specifically is the most efficient way to get that money into his policy. So what we've got here, again, an age 50 male. He's got $1 million total, and his goal is to get that into a whole life insurance policy. Cash value, that's what he's interested in. How do I maximize the cash value so then I can use it for opportunities? How do I get money in quickly so I see the cash value grow at the fastest rate? That is what he is interested in, which is what most people who we work with are interested in. So what we want to look at here first is the most efficient number of years. So we're going to look at 3 examples. We're going to look at the same company, the same product, same health rating. Everything will be an apples to apples comparison, except for how he gets the money into the policy. So we'll look at scenarios A, B, and C. Scenario A will be a one-time check for $1 million that he sends to the life insurance company. It's deposited into his policy. He pays nothing thereafter, and he watches that cash value grow. That's scenario A. Then we've got scenario B, which will display funding the policy at $200,000 per year for a total of 5 years. $200,000 times 5 years is how much? $1 million. So he's getting the same dollar amount into the policy, but spread out over 5 years. And then we've got scenario C, which will display $100,000 per year paid into the policy for a total of 10 years, which is, again, a total of $1 million. So which one gives you the most money? That's the question. If you see a life insurance company with a dividend rate of 5 or 6%, that's what they're paying on whole life insurance policies. If you get money in 1 year compared to 10 years, which one should give you more money? Remember years ago, when I was early on in my career, speaking with someone who was a bit older, he was in his 60s, I think he was 65 when he started. He had close to $1 million that he wanted to pay into a policy. And he said, hey, if I just write a check for the full $1 million, shouldn't that earn the highest return because it starts compounding right away? Like, that's what I want to do. I'm like, you can do that technically. However, it won't give you the most money. All right, what do you mean? Show me. That's what I want to see, because it should, based on common sense and how math works, or how numbers work and such. So we're going to look at these 3 scenarios, again, all with the exact same company and exact same product. So option A was what? $1 million, one-time payment. So what we've got here is the $1 million added to the policy. So pretend this is you. You're 50 years old. You say, I'm going to send this $1 million in, and my first year cash value is just about 95%. That's a very rich upfront cash value, by the way. He has a massive death benefit of $15.7 million. And notice here that the death benefit is high for the first 7 years. Why is that? So specifically, why is it so high? And why is it so high only for 7 years? Here are the reasons. So 1, why it's high, $15.7 million, it could even be difficult to qualify for that, is because the death benefit has a direct relationship to this term, MEC, which represents MEC, our MEC limit in this case. So with this product, for a 50-year-old male, $15.7 million gives him, guess what? A $1 million MEC limit. That means he can pay $1 million into the policy in the first year without the policy becoming a MEC. That means he can access the cash value without taxes and penalties that a MEC would normally have. We've got a video that goes through the modified endowment contract and how it works up on the top of the screen. But that's why the death benefit is so high. Now, why it's high only for 7 years is another name for our MEC test is our 7-pay test. This specifically has to do with the first 7 years of a life insurance policy. We'll call it the vice grips from the IRS are very tight. After the first 7 years, what we can do is reduce the death benefit, which reduces the costs, without triggering this MEC, this taxable event. If we were to reduce the death benefit, say in year 2, where I'm not paying anything and I don't want to carry a high expense that's going to drag on my cash value performance, if we cut it in year 2, we'll trigger a MEC. So we have to keep it high for at least the first 7 years. That's the main item to be aware of when we see this high death benefit. What we don't see on this Excel workbook is the premium and term insurance rider costs that are associated with the policy years 2 through 7. However, the cash value here is assuming those costs. So this is displaying the net cash value after all expenses and everything are satisfied here. So the policy is able to cover the premium, able to cover the term insurance rider that we have attached to the policy, and still go up. That's the most important thing here. We see a break-even point of year 4. That's when we get our money back. So considering this is a one-pay, which is not the most efficient strategy, it's not bad, in my opinion. Now, I wouldn't do this personally because we can make it much better, but it's not bad. Let's look at the next scenario. So what we've got here is the 5-pay. Same product, but $200,000 per year. $200K in, death benefit, $3.15 million. Do me a favor and multiply that by 5. What do you get? Look at that, 15.75. What was the death benefit on the one-pay scenario? 15.7. So I can fine-tune this to make it exactly 1/5 of 15.7. But what we've done is reduced the death benefit to what? To the dollar amount needed to give us a MEC limit of $200,000. So I know this can be technical. To illustrate, what we're doing is reducing the expenses as much as we possibly can in order to maximize the cash value. We're lowering the death benefit to the minimum amount needed to attain this MEC limit of $200,000. So we've got a lower death benefit, which will result in a little bit lower costs. But here's the big thing. We've got a $200K MEC limit, and we're funding up to that MEC limit for 5 consecutive years. In the example to the left, the one-pay, you have a premium that's still due years 2 through 7, and the policy supporting that on its own. In this example, you're supporting the premium and adding money to the policy through the 5th year. Then, years 6 and 7, you still have a premium due, the policy is paying for itself, and it can handle the cost no problem here because you're already off the runway. So you might be comparing these two already. You will see a big difference here at the year 20 mark alone. And again, exact same product, exact same dividend rate applied, just funding it a bit differently. Which one's the most efficient is the question. Let's look at one more, funding it for 10 years here. And what do we see? What's highlighted in yellow, by the way, is the break-even point. All of them are right at year 4. That 5-pay is between years 3 and 4. The 1-pay is year 4, and this 10-pay is also year 4. What do we see here? Looks good. Is it as attractive as the 5-pay? No, it's not. We start to go backwards here. While we are funding the policy for 10 years, we're getting the money in slower. And we still have compound interest, and just how that works. The faster we get money into a policy, the sooner it begins to earn dividends and interest. The balancing act here is this. How do I get money in quickly so I can take advantage of the dividends and interest, but keep the drag or the insurance expenses, which is when a premium is due, but I'm not paying it? How do I keep that at a minimum? What's that sweet spot? And if I want the simple version of that is, what number of years should I get this lump sum into a policy? Based on my age, it's going to be anywhere from 2 to 5 years. So let's do this next. Let's look at the cash value difference between these two scenarios. So what do you notice here? We've got the 1-pay on the left and the 5-pay on the right. This is interesting stuff, isn't it? The first year, you're going to have more money in the 1-pay because you got it all in up front, and you'll actually have more money through the 4th year because you've gotten $1 million into the policy, whereas over here, you've only gotten $800,000 in. However, once you get a total of $1 million into the policy, what happens? That 5-pay has the most cash value. As we look at it long term, you've got the most death benefit as well. And as the years pass, it becomes substantially noticeable in terms of how much more you have in cash value with the exact same product, but just funding it in a different manner. So when someone's interested in front-loading a policy, or in this case, adding a large lump sum, what I'm interested in is, A, do you want to pay anything in after that? Or is it a case where you've got a sum of money, you want to get that in, and then you're done, you want to optimize it? If that's the case, I do want to show different options that are going to provide the most value. And what I'll say at age 50, the sweet spot actually for someone 50 years old, assuming they don't have any serious health issues, is going to be between 3 and 4 years. 4 years from a guaranteed and non-guaranteed standpoint will look very attractive. But a 5-pay is perfectly fine to look at. There won't be that much difference in cash value and death benefit performance. Let me show you something real quick with the illustrations here. So here's the 1-pay. You can see the company they're with. Here's what's interesting about this. The most we can illustrate with the Guardian policy is wherever we set the base premium, we can illustrate another 10x that in PUAs every year. We can do that beginning year 2, and we can do that as long as we have a 1-year term rider attached. If you don't, the most you can illustrate is 3x the base premium. I said 10x though, beginning when? 2nd year. Year 1, we can go up to 50x. If you've got an older Guardian product, this wasn't always available. So up to 50x in the 1st year. That's why we have this low base premium of $20,000. We shrunk it as much as we could. 2% base premium. 2%, what's with the 2%? All right, so 2% base premium. You've got a lot of term insurance attached. So here's your term rider cost for one term rider, $7,200. And you've got one down here, about another $3,000. So you have a decent amount of term. These are also term insurance riders that renew every year and gradually increase in cost, but only through the 7th year, and then we chop it off. So the cost will not be excessive. And even when we look at this, the costs are not exceeding the growth on the policy. How you can tell if the costs are too high is if your values go backwards, which they're not here, which is good. We don't want them to go backwards. But as we look at this, we pay nothing after the 1st year. What's happening is, again, the policy is paying for this $20,000 premium and the term rider cost, which we do not see on this page of the illustration. It's an added report we can include. Then, this example, there's your 5-pay. So the premium's only a little bit lower here. And the reason why is because we can illustrate 50x only in the 1st year. Beginning year 2, it's 10x. So what we did, you can see it here, took the 200K premium, divided it by 11, that's where we came up with our premium. I got to round up 1 penny. Otherwise, I would get $199,999. Okay, so 200K per year, years 6 and 7. What happened? There's your premium. Still due, but the policy can easily satisfy that through dividends alone, and that column does not include the guaranteed portion of earnings either. There's your cash value and death benefit, which will match the Excel workbook. So that is the 50-year-old male, the different funding options. The one thing that I will add is we also looked at another product here for him, 10-pay policy, which is not for everyone. It definitely has some serious potential from a long-term cash value, a growth standpoint, and death benefit for that matter. But what you'll notice here is the premium is higher, with the exception of the 1st year, where we can illustrate 50x the base premium. Beginning the 2nd year, the most we can illustrate going into PUAs is an additional 5x the base premium in PUAs. So what a 10-pay product often does is force a little bit higher base premium, or much higher than another product in Guardian's portfolio. And if I don't like a higher commitment, this one may not be a fit for me. But I do get typically 30 to 35% of that premium back in cash value in the first year. And also what it does for me, look at this, is give me some very attractive long-term growth. So if we go back to the example we just saw, by year 20 in the 5-pay, you had 1.875. Check this guy out, $2,030,000. This is based on the non-guarantees. This is a 10-pay is something we might look at with someone considering a large amount like this, but I would also go through the guarantees and such. There's some drawbacks, some things that might take the sizzle of that steak away a little bit. It looks like a filet mignon, but then you look at it and say, okay, it's still a good steak, but I mean, it's not the center cut piece. I've got a New York strip or something that I might like a lot, but I might go with the other option too. 2 options though. We'll keep it simplified. Once we narrow down how long we want to fund, or if it's just 5 years, if this is the option, we would compare the 10-pay, or we're only paying it for 5 years, we would compare this to the L95 we looked at on the first slide. But what do we see here? Similar situation to the last set of illustrations. Break-even's a little bit delayed. I do have less up front with this option. As we look at the comparison by year 20, there's your difference. About an $80,000 difference by year 20, where you've paid in a total of $1 million. But it's interesting, just when we look to maximize the cash value of a policy. In this particular case, we're looking to get $1 million in and make it as efficient as possible. In this particular case study, the winner was option B, funding it over 5 years, the $1 million payment. So I do hope that this video helped. Let us know your thoughts. Please feel free to leave any questions and comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.